This conference will now be recorded.
All right, so yeah, it's already 12:05. So let's start the session. First of all, a very warm welcome to all of you for taking your time out and joining in this workshop. Right. So I'll lay down some very basics. I'll give a little bit intro, and then I'll hand over the session to Rupal, and he can then take it forward. Right. So first of all, as you all know, that this workshop would be spread over 2 days, same timing today and tomorrow, 12 to 1. Of course, post the session, we would have a post the session. We will have a small interaction as well on your questions. So today's session will be conducted by Mr. Rupal, and we are lucky to have him conducting this workshop. He has a vast experience in the areas of leading teams for valuations of derivatives, risk management, risk modeling. He has been working in fintech for quite a number of years in all leading international banks, and he is an IITian. He has done his BTech from IIT Kanpur and also has an MBA from IIM. Now, about some basic instructions for attending the webinar. My request would be that all participants during the webinar, I'll request all of you to be on mute. Only the speaker will be speaking. The participants will be on mute. If you have any questions, I'll request you to type in the chat window. We'll collate the questions. We'll collate the questions, and then we will try to address most of them as much as possible. With that, I'll hand over the session to Rupal. He'll take you through the decision today as well as tomorrow. With that, Rupal, you can take it forward from here.
Yes. Hi all. First of all, thanks for attending the session, and probably as you must have read the statements that have been shared with you. Mostly, the session is going to be around. The workshop will be small. It's just a 2-hour session. Usually in our classes we take it as a lengthy session, but here it's within the time limitations. We'll try to cover something. Of course, the idea is to introduce you to the pedagogy that we are using for our Monte Carlo simulation, which is an example of the overall scheme of things that we take up in our classes. Okay. So thanks to Nidesh for conducting it, and of course allowing me to present. So I will take you through the workshop on the Monte Carlo simulation. Okay. So if you have read, I think I had started with the famous quote on poem from Robert Frost that was two roads traversed in a wood, and I took the one less traveled, and that has made all the difference. So when I was talking about that, of course the theme of that poem was different and the theme here is different, but the ideas are same, that depending on the path that you take, the end result that you get is actually that one. So basically the end result that you are getting is somewhat dependent on the path, and that is what simulation does. That's what the fundamental of a Monte Carlo simulation, especially in stock price modeling, is. When you are doing stock price modeling in Monte Carlo simulation, there are multiple paths that you will see, and all across leading to a different price. So basically, we have to take those prices and draw our inferences that we want to draw. Again, it depends on why we are doing Monte Carlo simulation. What is the reason that we are using Monte Carlo for that stock price? There may be multiple reasons, multiple applications. We won't be focusing much on the application part of Monte Carlo simulation, but we will definitely talk about it. Like why is simulation? Why do we need to do Monte Carlo simulation for a stock price? What is the requirement? So definitely there are many. If anybody wants to put something in chat box on this, like why do we do a Monte Carlo simulation, please feel free to do so. Otherwise, of course, I'm going to tell that basically as a risk manager wants to know what is my value at risk. That is where you need a Monte Carlo simulation if you don't have enough of historical data. If you don't have enough of historical data, you need Monte Carlo simulation to get down to that value at risk number. Regulators, these days, regulators are also pushing hard for it. Regulators are also pushing hard for it. That is also an area where we need the simulation to be done on our stock prices. Option price calculations. That is where also again we need what is going to be an estimate of the future prices. With what estimate we can say that okay, our future price is going to be this, our down the line 10-day hour price is going to be this, and that is where again probably we need the simulation to be done. So these are some of the areas where we need this Monte Carlo simulation to be done. Now coming back to simulation fundamentals, start from there. Exactly what is simulation? We understood that okay, we need simulation. That's something that you already know. Okay, we need simulation. A risk manager needs simulation for value at risk. Simulation for an option price valuation. Regulators are asking for simulation for their own limit setting or any hedge fund or any institution who is doing trading. They want to set a particular limits for them. That's where they also need Monte Carlo simulation. They are also stressing for using Monte Carlo simulation by the institutions. These are some of the areas that where we need this simulation to be done. Coming back to the fundamentals of simulation. What is simulation? It is all about replicating the conditions or processes of any physical or real life system in order to study its behavior or dynamics or evolution in time. Okay. Basically, when we talk about simulation, we can't have any process to be tried and tested firsthand directly in a real life situation. So we need to create an environment, as we call it. We need to create an environment, and within that environment, we need to put our system or whatever we have built and run through a process. So creating an environment or replicating the conditions, as we call, is like creating that environment, artificially creating that environment. So if stock is going to be traded in market, we are artificially creating a market kind of situation and then trying to understand or study the behavior of stock. As we are focused on only simulation in financial industry, therefore I am talking more on stock. Otherwise, in the next slide we are going to see simulation is not only about stocks. It is just an industry in which Monte Carlo simulation is being used. Otherwise, the usage of simulation is wide across industry. While doing simulation, we usually use two types of model: physical model or a mathematical model. A very classic example of physical model is if you want to simulate the process of an aircraft flight, we will build a small model airplane and simulate the flight in a wind tunnel. Your voice is not clear. Is it any better now? Is it better now, guys? Yeah. So basically, when we are talking about two types of model, the first model that we are talking about is physical model. In a physical model, it's just an example that we've taken. That's the process of an aircraft flight built in a wind tunnel. The other is a mathematical model, where we want to study what happens when a ball bounces off the floor. So we have Newton's equation. We have the Newton's three equations of Newton. V t equals to u t plus half gt square, or v equals to v square equals to u square plus 2af. These are the second and the third equation. These equations are used to model how a ball bounces off the floor, so how much height it will go, how much height it will not go, because we have the mathematical equations in front of us. And that is what I will just take a quick minute on explaining what we mean by a physical simulation. What we mean by physical simulation. When I was talking about our aircraft example, what happens is that there is a wind tunnel. It's a wind tunnel. Within this wind tunnel, an aircraft has something like this. Put up. These are the wings of aircrafts. Excuse me for my drawing, it is not that appropriate. These are ailerons. These are the straps, the straps. And now, within this wind tunnel, exactly wind will be passed from here. That is what we are talking about. Wind will be passed all across. Now, when an aircraft is flying in a normal environment, then also wind will be crossing the aircraft. So now we need to model the velocity of wind. We will have a range. We will have a range within which we will be putting across the wind flow. The direction of the wind, this is one direction. There can be any other direction as well. This is another direction of wind. Exactly, right? The velocity of wind is one parameter for us. Direction of wind. That is another thing. So these are, it's just an example. These are the two parameters that I am considering while an aircraft is put in a wind tunnel and how it behaves. Now, the way how the aircraft will behave will tell us the model that we have built in, the aircraft model that we have built in. It might be, it might not be suitable for a certain kind of velocity. It might be suitable for a certain kind of velocity. It might not be suitable for the it might not be clear for, I mean, any kind of different environments. If it's a warrior aircraft, we need it better. We need it rugged. We need the aircraft to be following any kind of environments, the velocity, direction of wind, a tough environment. If it's a passenger aircraft, we don't need that kind of capabilities, because adding capabilities to an aircraft is adding costs to it. So this is one of the classic examples of simulation that we are talking about, general, and yeah, that is the first, building a physical model. Now, when it comes to mathematical model, of course, the stock price simulation that we are going to do is another classic example of mathematical model of simulation. Or as an example that we have taken, a ball bounces off the floor. Basically, mathematical model is about equation, and physical model is about the way I have shown a wind tunnel, and within a wind tunnel, an aircraft. I hope it is clear now. Coming to what does it mean when Monte Carlo is added to the simulation world? Monte Carlo simulation is one particular method of computation simulation of a mathematical model. It involves using random numbers drawn from different probability distributions according to the nature of the system being simulated, and various stochastic variables involved in the system, which are involved in the that is again something basically in terms of stock price simulation that we use. When we talk about Monte Carlo simulation in Excel, we use the first of all when we talk about this simulation, we are talking about models. We use certain kind of models, and within those models, we are trying to generate the certain set of stock prices. And when we talk about Monte Carlo simulation in Excel, we will see what kind of Monte Carlo simulation in Excel is that we are going to use. Okay. Basically, when we talk about models, we should be talking about equations that we are going to use. We should be talking about equations that we are going to use. When I call about equations, this is one of the classic equations. This is the classic equation of Monte Carlo simulation that we should be using. Okay. Yeah, I'm pausing because I just don't want to run away with the process. I just want to grasp what we are trying to do here. So this is one of the examples. This is one of the simulation equations that we are going to use when we are trying to model our stock price. And for a process on how a ball bounces off the floor, I already told you that okay, we have the equations from Newton. We have the equations from Newton that we are going to use. Okay? That we are going to use, and within those, with that equation, probably we are going to model the ball price simulation. Similarly, Monte Carlo simulation to address the stock price modeling. This equation, I think some of you might already be knowing it, some of you might not be knowing it. It's a geometric Brownian motion equation. As we spoke of, when we are doing mathematical modeling, we have to define a model. We have to define a model and we have to use that model. And here, that is our model, the geometric Brownian motion model. That is the model that we are going to use, because if what will happen if we don't have a model? For example, if we see what will happen if we don't have a model, things will go out, things will blow out anyway in random, and the stock price can be from 0 to infinity. There is no limitation to it. But in real world, we have to model it in such a way that there are limitations to its valuation, right? And Monte Carlo simulation altogether is an attempt to predict the future. When you are trying to predict the future, okay, yeah. Is it any good now? Is it better now?
Yes.
Yes. Okay, thanks. So we're talking about stock price simulation in Excel. And when we're talking about stock price simulation, as we spoke of, it's a model that we are trying to build across. And with that model, we are trying to simulate the Excel price. So when we say that we have defined the model, yes, the model is in front of us. It's a geometric Brownian motion model. When we say a geometric Brownian motion model, there are already some of the inbuilt features of that model, which are like the model will follow a random walk theory. The model will follow a random walk. And it is at the very least consistent with the efficient market hypothesis. It is at least at the minimum consistent with the efficient market hypothesis, at least in its weakest form. If not in its advanced form, at least in its weakest form. Okay. So once we have defined the model, the formula that we see is ds upon x is equal to mu dt plus sigma epsilon square root of dt. We shall be defining the terms as well. What is S? Our stock price. What is DS? DS is the change in the stock price. DS is the change in the stock price. What is mu? We can call the mu being expected return or the drift. Usually it is drift that is used, but in this case we can consider it as even the expected return from the stock over a period of time. Okay. Sigma, the standard deviation of returns that we have. And epsilon being the random variable. So when we talk about epsilon, we are talking about the random variable. And this is exactly the variable that we are going to change to get different values of change in stock price, which is delta S. And as an example for a wind tunnel, we were changing the velocity and the direction of wind. The speed and the direction of wind, which is cumulatively called as the velocity. In the same manner, here we are going to change this random variable, and with this change in random variable, we are going to get different values of change in stock price over a period of time. And that change in stock price is being recorded, which gives us the new stock price. So let me quickly run through you about the process that we do actually in a stock price modeling. What actually happens in stock price modeling? So if you see the equation that we have written for geometric Brownian motion was ds upon x is equal to mu dt plus sigma epsilon square root of d. Okay, This was the equation that we already written. There is a difference when we call it dx versus delta s. This, if you recall in your 12th class mathematics, you must have done this in differentiation and integration. This is for a continuous equation. This is for a continuous process. And this is discrete process. So when our delta t is going to be like 1 day or 0.5 day or any such number, discrete number, it is delta t. And when it is dt, it's continuous. So this is a continuous form of equation. If written in discrete form, it will become delta s upon s is equal to mu delta t plus sigma epsilon square root of delta t. This is another form of the similar equation in discrete format that we should be using while predicting the stock price for future. Understood? Just rearranging the formula. Rearrange formula. We have delta s is equal to x mu delta t and sigma epsilon square root of delta. This is the geometric Brownian motion. What exactly is the essence of geometric Brownian motion that we are trying to show through this formula, through this equation? Let's quickly see that. What is this equation trying to signify? It is trying to signify that here is your process. This is your drift, which is our mu delta t. We should not be getting confused with that mu is the only expected return. No, mu is actually drift. Okay? This is again a drift. The drift tells us the direction in which our stock price is moving. Drift tells us the direction in which our stock price is moving. It is moving in an upward direction. The stock might be going up. So this is what exactly the drift is. That may be doing a certain direction. It is increasing price or decreasing. Okay. The first term that we had is something that we already have now. We can write this here as mu delta t. This is what we write down here. Then how does drift is affected by the shock or the volatility part of it? How the drift is affected by the volatility part of it? The shocks are something like this. Shocks are something like this. These are shocks. The second term that we have. These are shocks. The second term that we have in the equation. The shock can be positive or negative. I have written dt once because it's for a continuous function. This is for a discrete function. So this is the shock that we are having. So these are the two terms that reflect the change in stock price. I will just write it down over here. So this is our equation. The two terms of our equation.
certain things which are not with machines. We have feelings, we have our perceptions, we have our belief system, we may come from the different culture. So all this tied up, and then we build our opinion for some things, and then sometimes it creates a conflict. There is an article from a professor and from South Carolina University, and then when she studied the couple of Fortune 500 companies, she found that all the conflicts which happen in the workplace are mostly in two categories. There can be many, but majority of it are in two categories. One is the one which Amol talked about. It can be related to your communication, your personality related, which can fall into the relationship conflict, right? And when we go there, we just stop talking. I hate that person. I'm not going to talk to him or her. Second is the task-based conflict, which Saurabh touched on. The way, the process you assign your work, or the process you choose who will do the work, that can cause the conflict.
Hello. I hope it is audible now.
Yeah, apologies. Somebody else actually unmuted and started speaking. Please continue. I mean, we could not hear probably half a minute or 1 minute.
I think somebody else was giving a presentation on workplace.
Yeah, I mean, sorry for that, all of you. I mean, I don't know. Somebody muted, and maybe somebody is attending two sessions simultaneously. We were hearing a little different noise. Absolute apologies.
Yeah.
Please continue.
So we had the shock and we had the drift, and this is how the model takes place. This is how it is done. So that is the essence of the equation that we are having. That is the essence of the equation that we are having. That this is how our process is going to be. Right? This is how our process is going to be look like. And with this process, we generate random trials. With this process, we generate the way we have done here, something similar is done, and we generate random trials. We generate trials. I will show you the example of some of the trials that we are going to use. So basically, let's say if you have a price of rupees 100, trials can be something like there is a barrier of 120 and there's a barrier of 80. Within that parlays, your prices can be anything. Let's say if you take an example of 10 days, or I will take 22 days, just a quick example. I will take an example of 22 days, because we are going to replicate this in Excel as well today. For 22 days. So there can be multiple prices, multiple paths, as we spoke of at the start. There can be multiple paths. Why there are multiple paths? Which is the variable getting us to these multiple paths is our epsilon. It's our epsilon. It is taking us to multiple paths. And the result is we have a certain set of simulated prices. These are our certain set of simulated prices. Set of simulated prices. Now, after we have this certain set of simulated prices, what are we going to do with this certain set of simulated prices? That is, again, depending on the application for which we are doing Monte Carlo simulation. As an example, if it's for an option calculation, we are going to take all the prices. And we are going to take, if you all know that option works primarily on the payoff. That at the end, the payoff can be either maximum of 0 or stock price minus strike price. We will take all the stock prices, we will fit it into the equation for payoff. We will discount it to today and get the price of the option. And trust me, even if you take a nifty option and try to model it using Monte Carlo simulation for around 10,000 simulations or more, you are going to get very close to the price of the option that is currently being traded in the market. That is the power of Monte Carlo simulation. There is one more assumption that we are going to take, which I will show you while we are trying to model it in Excel. I will show the implementation part of it. So that is what the power of Monte Carlo simulation is. That is for the option calculation we are using it. For a value at risk calculation, this can be this certain set of prices are taken, and of course the approach for value at risk calculation can, if the set of values are 100 for us and we are calculating the 95% value at risk, the fifth lowest value is something that we are going to pick up. So for overall simulation, we only need the fifth lowest value. We will take the set of those fifth lowest values across each simulation. So let us now quickly see through an Excel. I'm trying to replicate what is our this simulation that we have just now done. How does it look like? How does the simulation look like? I will open an Excel file and will start showing it over there. Of course, the method that we are using right now is the discrete method. The method that we are going to use is our discrete method. We are not going to use the method which is continuous as for now. At a later point of time, we might do, but not right now. In this case, the parameters that I have taken are the stock price, which is 100. Sigma, our volatility that we took is 7%. That has been considered 7%. Our drift, I have taken a fixed value for drift, which is 0.1. Which is 0.1. Drift is 0.1. dt, the time step that we are going to take. dt might have different values. In this case, I have taken the dt value to be 0.01, but we can take it to any other value. Let's say 0.25. I will take it as rather than 0.01, I can take it as 0.25 also, as an example. So basically, if you have, as an example, if you have 22 days, so you want to calculate the price post 22 days. So basically, each day, if I am taking my dt as 0.25, I am dividing each day into 4 parts. I am dividing each day into 4 parts. So 1 divided by dt is the number of parts in which you are dividing your time. The dt time, which is a day, but it is broken down into 4 parts. Let's see how it looks like in terms of our dt. At time t equals to 0, we don't have drift, we don't have uncertainty. The two major parts of the equation that we see. Of course, there will not be any change, and our stock price is going to be okay. Our stock price is going to be $100. This is our time scale. Just a moment. Okay, now it's done. Yeah, now it's done. This is the template Excel that is already usually shared before the class, all the students. And I think when I am doing it in class, in general, what we do is that we take this Excel. I will do the modeling in this Excel. Understood. I was just explaining the process that we follow in our lecture. Is that this Excel will already be shared with you before the class. Now, while I am doing it in the class, we would expect that students can themselves also try it at their home and model what we are trying to do here. Okay. So this was the time step. As I told you, this is the time step. So this value is exactly your previous time step plus this value. What is this value? This value is your this value plus the DT. So if you take it till 22 days, somewhat close to this. Okay, we have to fix this value actually. That's the problem was. Sorry. We have fixed the value. You will get something like this till 5.25. Okay, extending it. I want the simulation date for approximately 22 days. That's what assumption that I have made, that I will get the price after 22 days or something like that. 20.5 still. We need some more days, some more data points. So this is exactly till the end of 22nd day. The price, the stock price that we are going to have here, that is the price exactly which is our end price. That is the end price that we are going to get. All of the prices will be the end of day prices in the interim that we are going to do. All the prices that we are going to have as the interim prices that we are going to do. Now let's come to the drift part. Let's come to the drift part. The drift part calculation is pretty simple, as we have already seen. It's simply mu into delta dt or delta t, the change in time. It's simply mu dt, and we call that simply multiplication of multiplied by dt, multiplied by, of course, the stock price that we are having, because that is going to be there. Our equation was delta S is equal to S into mu dt plus sigma epsilon square root of Vz. Next comes our uncertainty. What is our uncertainty? What did our uncertainty include in terms of its formula? It was epsilon. I would say it was first of all sigma. We will take the value of sigma here, which is volatility. Okay. That will be a constant term. That will be volatility. Multiplied by the square root of dt. And use the formula square root of dt that we are going to have. Again, a term which is constant. dt will not change all across the simulation. Then comes the epsilon term, which is our exact variable that is going to cause the overall uncertainty or change in price. And this uncertainty or change in price, the another assumption that I was talking about was that we are assuming that the stock price follows normal distribution. This is a very generic, extremely generic assumption that is made all across the financial industry, that any stock price or any basically what do you call the Sensex or the Nifty or any kind of these things, they all follow a normal distribution. So considering that is the assumption that all of them follow a normal distribution, we are going to use that normal distribution in our formula. Basically, inverse of normal distribution, and you will take any random value. You will take any random value. Any random value with the conditions, what is the mean and the standard deviation? I am taking the mean as 0 and the standard deviation is 1 because the drift and the standard deviation that we have used are already separated out. If they are already separated out, we will just take a standard normal distribution and fit it into our model that we are trying to build. So a standard normal distribution is common for all stocks, all Sensex and the Nifties and all the things. They are common for all of them. So we are going to use that standard normal distribution, which is being represented by norm dot inverse with a random function of this. Okay, and ultimately, of course, the stock price that we are going to use. This gives us a negative value. It can give us a positive value or it can give us a negative value. The good part is that this value will change. That is what I was speaking about. The value will change. Why the value will change? Because it's an uncertain value. The term itself defines it's an uncertainty. Our change is the addition of these two. This is our change. And our new price is the addition of this plus this value. So this is one of the prices that we are getting. Now if I take it till the end, these are the values that I'm going to get. I'm going to take uncertainty also till the end. Change in stock price till the end. Exactly, this is what the simulation is. The last value that we are going to get is something like this. It's very high. It can be, the value can be very high, or it can be extremely low also. It all depends on what we are trying to get out of it. What are the parameters that we are using? The parameter is large, the value will be large. The parameter is small, the value will be small. The value is even 1091 also. As you can see, they are simply, the value is as small as 964 also and as high as that is not also. So the values, if you see, are going to be anywhere from 0 to very high value. But there is a certain limitation on the highest value that we can have. There is a certain limitation on the highest value that we are going to have because of the parameters that we have used, which are volatility and drift. Because our parameters, volatility and drift, are monitoring, are having a certain level, which is 7%. So to be very honest, 7% volatility is quite a high level of volatility. If we are having that kind of high volatility, then of course it's going to be that one. Going to be that way. What I can do is we'll quickly take these values. We'll quickly take these values. And we'll go to draw. Sorry, is that a quick graph? I would like to is that a quick chart for it. Or is that a quick chart for it? This chart is looking something like an increasing chart. What is the reason for the chart being looked at as an increasing chart? Because our drift was positive. As the drift was positive, as we had already spoken about while modeling, that drift gives direction. Even if you keep on changing the values, the graph will change. If I just click on anything, the graph will change, but the shape of graph will be different because uncertainty is different. But the direction will remain consistent because our drift is 10%, which is very, very high. 10% drift is quite high, plus it is in positive direction. If it is always in positive direction, the graph will always be in positive direction. You can of course change the parameters of graph, select data, and edit it and keep it the values within the range from here to here. That is all in terms of change that you can do in the graph. So that will show you the values in a better way. Basically, these two things are being plotted. But
Hello,
the change
Ruben, sorry
graph is
to
doing like this.
sorry.
Now,
Could you just repeat the drift part, like the drift formula? I missed on that. So if it's possible,
you're not audible. Give me a
Sujan,
moment.
your
I'm sorry.
voice is not.
I'll just repeat. Just repeat the drift formula. I missed on that part. So I was just not able to continue on the. I got on the other ones, but not the drift part. You could just show the
Okay.
formulation.
The drift is a very straight thing that we are trying to do. Drift is clearly multiplied by the change in time, and that is multiplied by the change in not change. Exactly the stock price. What was here? This is the formula that we have taken into consideration. This is the formula that we have implemented just now. Our drift is this S mu delta T. This is exactly what has been done in Excel. And then S sigma square root of delta T into norm inverse of random. I think I have written it in Excel, so I won't write it here. Probably that's not a good idea. But this epsilon, this value we have written as norm inverse of this. With the drift being positive, it will be in increasing direction. Drift being negative, it will be in this direction. It will show it to you. Let's say we make our drift as negative. The direction of stock price clearly changes. It will always be negative direction now. Whatever be the simulation that you run, see, it's going to be negative direction. If it is 0, it will be flat. There won't be, the direction will be straight. See? The direction is going to be either changing. It's only the uncertainty that's causing the problem. Right? You can see it in graph. okay, we have recorded these, we have done the simulation. We are doing multiple. We can run such 1,000 simulations or 10,000 simulations. But what next? We have to record these simulations. We have to record these simulations. We have to record these results. The result at the end of 22nd day. The line in yellow, we have to record this. And after we have recorded this, we can do anything with this data. And we already spoke of at the start of the session itself that why we are doing Monte Carlo simulation. Because we need to calculate valuations. We need to calculate option price valuation. So we need to record this. We need to store these values and do whatever manipulations and calculations we can do it. Okay. Now, this leads me to the next part of the workshop and the webinar that we are doing tomorrow. Recording these values. Recording these values, and after recording, doing calculations with these values. Otherwise, why we are doing Monte Carlo simulation? Right? We have to record these values for each simulation that we are running. When I say each simulation, this is one simulation. This is second simulation. This is third simulation. This is fourth simulation. Each simulation is giving us different parts. That's what we started the session with, that poem from Robert Frost. That there are multiple parts. Multiple parts. We have to record those parts. And how will it look like? And we are saying, this is just an example. These are the parts, stock parts that will look like. These are the time scales as we already taken. We already taken 0.05. They have taken it 0.05. I have taken it as 0.25. You can take it as 1 day also. You can take it as 0.01 also. Okay. So that is how we go on. We will get to see.
I have a question, sir. Can I just ask, like?
Yes, we'll be answering the questions in a minute.
Oh, sure.
So basically, these are the different parts. Our tomorrow's session is going to be the implementation of this in Python. Now, just to give a brief about tomorrow, why Python? Because it's a language that has been used, that has been in the industry for quite a long time, and it is the future. Python is the goddamn future of the finance industry. So our sessions are always focused on using the latest version of Python and implementing all the exercises in Python. The latest version of Python, I would say, not only Python, the latest version of Python. We want like our group to be accustomed to the latest versions only. With the latest versions of Python, we are going to draw this graph. We are going to collect the values, and then, as a quick example, I am going to show you maybe an option price example. Let's say, depending on the time that permits, but we will show the valuation of an option, or we will see at least the values that we have collected, the values at the end of each simulation. What are the set of values that we have? Okay. I will end it up for today. We will take the Python implementation of this overall exercise tomorrow. And tomorrow exercise will not be only for, as in Excel, you are seeing just one graph. It will be multiple paths that you will see in Python. We are seeing only one path here, but such similar multiple paths we are going to see in Python. With this, I will end the session for today. And,
Wonderful, thanks. So we have like 3-4 questions. I mean, if you can quickly take it, Rupal, because that is pertaining to today's session.
Yeah, I have a question, sir. This is Sanchita over here.
Yes, Sanchita, you may start. Then I'll take the other questions.
Yeah, sure. Thank you so much. First of all, thank you, Rupal sir, for a wonderful session. It was very well articulated. Secondly, in this Excel example, you took the values of drift like of 10% and volatility of 7%. So I just wanted to know that, okay, so DT is something which we can figure out like keeping in mind how many number of days we want to analyze and stuff like that. So I just wanted to ask about volatility and drift. So how do we find out the percentage for that? Is it our assumption totally, or there is some analysis behind it? And also about DT, how do we know that it's 0.25? Like, for example, you said that 4 parts maybe are dividing. So but can it be 5 parts or 6 parts or 8 parts? Just a query. So if we have to if we have to apply this to a real life example, for example, if I am studying the shares of suppose Tata Steel or some company, so how will I incorporate this formula there? Like, what would be the volatility and drift in that example?
So let's start answering the questions that I asked. The first question about drift and volatility. The very simple answer to it might be the historical data that we have for any particular stock. Maybe last 1 month data, or last 1 year data. You can take last 1 month data or last 1 year data. Take those values and put up those values in our model. In terms of drift, it should be pretty straightforward. What is the expected return? To be very honest, it is usually either 0 or very close to 0. Okay? It is 0 or either close to 0. In terms of volatility,
Okay. Yeah.
in volatility, there are multiple ways now to calculate volatility. Okay? So, in fact, in our sessions that we are having in our UFRM courses and AMFE courses, we have separate sessions altogether on volatility as well, where we tell you how there can be different volatility. One very simple approach is take uniform volatility all across last 5 years, for example. We will take last 5 years data. We will give equal weights to all the last 5 years data or 5 years stock prices, and we'll calculate volatility. That is one way. What can be the other way? There can be some other ways as well. That I am living in 2020. I have seen COVID taking up all across the world. I want to take the volatility only for my last year. I want to give little weight to what has happened in 2015, and I want to give higher weight to what has happened in 2020. So that is another approach of calculating volatility. So these are the different approaches of calculating volatility. They are called as dark model or another kind of models that are used to calculate volatility. So I think GARP 1.1 approach is the best one that we call will be used to take volatility. Again, I can go on and have another altogether webinar on volatility. Volatility can be divided into 2 parts as well. It's a historical volatility and implied volatility. Which one you want to take? Ideally, implied volatility is the best fit for a model. You can get implied volatility from the options chain that we have. Okay. So these are the things, of course, that require overall analysis, but this is how the volatility can be calculated. At the very basic, you can take any historical data and calculate volatility. You can take last 1 month historical data, can calculate drift and volatility. That is the best, easiest approach. In terms of DT, and in terms of DT, as you asked for, DT is all our choice. Okay, depending on how many breaks at simulations that you are trying to put. The smaller the DT, the better will be the simulation result. That's what I can say. The smaller the DT value, the better will be the end result. Because you are doing multiple steps and multiple breaks in between. I wouldn't say it's a multi-step, but multiple steps you are putting and coming to the end result. So multiple steps means we call it better results. That's what you get. But it's your choice clearly. DT being 0.01 is a good assumption. 0.1 is a good assumption. Take that as DT and do the calculation and do the.
Okay. Yes. So, sir, you are saying that for the past historical data, for example, 1 month data, we find out the expected returns. So that would be the drift. quotient. So just 1 month, for example, we can take it a year as well or 5 years as well. So expected returns would be drift, and to find out and if we find out square root of variance of all the values, then that would be the volatility.
Exactly. To calculate
Okay.
what is the easiest way? Take any historical data series from Yahoo Finance or any website that you want to choose. Calculate returns. Take those returns. Take the summary of those returns in terms of expected value and standard deviation. That's your quickest way to get it. Not the
Okay.
best way. It's not the best way. It's the easiest and the quickest way to get it.
Okay. But then that's not accurate in many cases. I mean,
That's not the best way. It's the easiest way.
okay. Okay. And what is the best way? Like,
Best way, as I told you that, best way is all about which kind of volatility you should use. Now you tell me, if you are given a volatility that reflects 2020 more than 2015, and you are given a volatility that reflects uniformly 2020 and 2015, which one will you choose? Which one will you
the one which is different.
The one which is different, the one which puts more weight on 2020, because we are more close to this time right now. On
Right.
20, standing more close to 2020. I still
Right.
have that in my stock prices. So I would like to have that more compared to what I have for 2015, because 2015 is gone. Now we don't have to worry that much about 2015.
Right.
So of
All right.
course, volatility like dark convert model, as I spoke about, it's another better way using that volatility.
Okay.
And as I mentioned, I will reiterate it that in our session on EMFE and QFI courses, on any of the courses, we have this kind of separate sessions altogether for volatilities also, where we devote
Sure. So
5 to
if
10.
you could just forward us those links, or you could have separate sessions, just let us know because we'd be interested in that.
Yeah, Nitish, I think.
Yeah. Thank you so
Yeah,
much, sir. Thank you for your time.
yeah. Sanchita, what Rupal was meaning is like that's part of our courses, right? So those are long duration courses. Of course, this is a short workshop where we are trying to give you an idea about the Monte Carlo simulations and the related areas, right? But again, we take up all this in very, very detail, right? In our courses, which are spread across 6-7 months.
Okay.
So there we
All
have more
right.
scope. That's what Rupal meant.
Sure, sir. You could just forward us the links or something of that sort. Just let us know about it.
Sure, sure. We will share the links of those courses, and you may take a look.
Yeah. Yeah. Thank you
We
so
have
much. Thank
courses
you.
on. Yeah. We have 3 courses in this: certificate program in quantitative finance and risk management, a certificate program in derivative valuations and risk analytics, and we have a very deep mathematical modeling course called certificate program in financial engineering. I'll send details of all these courses to you. Anybody else who requires these details, they can actually email us or let us know. We'll send details of our courses. Very quickly, can we take the other questions, because we are already 15 minutes past the sessions. Maybe most of the answers are actually already done, but again, I'll just take the questions of others so that like others don't feel left out, right? So Nikhil said that like, how do we calculate the parameters? Is it something you want to answer in a very brief time now?
Okay, I will just go back and take the question. What was it, Nikhil?
So Nikhil said, how do we calculate all the parameters?
Yeah, so I think this is already answered, right? How we calculate drift, volatility.
Correct.
I told you the easiest way, I told you the best way, choice is yours.
Right. Anyway, as I said, I mean, the last question that Sanchita put in, it answered most of the questions probably which others have put up. Similarly, Alok has asked on what basis drift is calculated, why drift is 0.1. That also has been answered. Someone who has not mentioned his name has asked, should we keep drift as positive for a long time?
No. Again, it depends on your historical data choices. I think if you take a trade-off Feb 2020 to June 2020. Let's take that period only. Or Jan 2020 to June 2020, the 6 months of COVID, highest COVID period in India. So, I mean, that will be the period in worldwide also, but in India, that had the biggest impact on stock market. The drift would have been negative during that period of time. If you take it from August till now, the drift would have been positive for most of the stocks. It's a clear cut. Depending on the time frame that you are choosing, your drift changes. What is the time frame that you are trying to put up for your simulation? Okay. That is how your drift should be chosen, which period you want to take. If you are looking out for any kind of mutual fund analysis or a bunch of stocks analysis, then take 10-year period. How market have behaved all across 10 years. Take that. With the best way, easiest and the best way to do. Okay. Did that answer the question that Alok has asked?
Yes, I think so. Alok, if you are there, I hope that has answered your question. All right, just a last question. Again, the same person who has not mentioned his name has asked this question. Normally, stock prices deviate from normal distribution, right? And in continuation, he has also mentioned in real life modeling, how do we assume that drift and volatility? This is we have answered. And what are more realistic numbers while assuming this if there is no sufficient historical data? I think we have dealt a little bit on this as well. Quickly, if you want to answer this, I mean, then we'll close the session.
If you don't have sufficient historical data, that's a very good question. If you don't have sufficient historical data, I would suggest, I mean, you know, again, a lot of research goes into this. Mr. Aswat Damodaran, if you just Google about him, he is a famous personality and he has published a lot of. So there is a lot of research around this that if how do you do a valuation of a company? He has taken from a valuation of company part that if you need to do a valuation of a company that has been currently rolled out, how do you do it? I will take that as an extraction and then suggest here that if you don't know or if you don't have a historical data of a company, that means it's a newly launched company or a newly launched firm that doesn't have sufficient historical data. To match the industry, match the basics of balance sheets, and get as close company as possible and take data from that company. Okay. So if IIQF is a firm, or I will not take example of IT, but let's say if ITC is already a firm, and there is another tobacco company that is as large as ITC, which has been rolled by, for example, Ambani or Reliance. They have put in that amount of money. So what should we do? We should take ITC as an example in terms of their returns, in terms of their standard deviation, and put it into the data for the newly launched company of Reliance, and just get to see the results that we want to have. Does that answer the question?
Yes, I think so. We'll be closing the session in a couple of minutes. Just somebody has unmuted and there's a lot of disturbance.
So Nitish, I have a question. So
Right.
recording of this session is going to be available to us, or?
Yes, recording will be made available.
Okay, thank you.
Okay, very quick questions, Rupal, in case you want to take this, or we can take this tomorrow as well. One, Alok has asked, can this modeling be done in Excel also? I mean, yeah, if you want to answer that.
Can this modeling be done in Excel?
Yes, that's what he is questioning.
Yeah, we can do it in Excel. Of course, we can do it in Excel. We can get the graphs also. I can try to show it. We actually in our sessions on Monte Carlo, we show it in Excel also. That large table that is built. There is a large table that is built. That also we show. But of course, with the advanced technology that we have, we prefer Python. As an institute, we prefer Python because of the ongoing technologies that are there, as well as of course, we want the people who take out our courses, when they go to the market, they should be in the best of the lot, having used the most advanced technologies. That is the basic reason that I think Nitish and all the directors in the firm, as well as the instructors like us, we all focus on using the latest Python. Otherwise, of course, it can be done in Excel.
Just to add to it, Alok, as Rupal rightly mentioned, a lot of these things can be done in Excel. But what happens is when you are talking about actual industry grade simulations which can be used in the industry, right? Again, you need to do million iterations and all that. I mean, for academic purpose, if you are doing small iterations and all that, just for your understanding, Excel is fine. But again, as I said, if you want to do industry grade things, but sometimes Excel is not good enough. So you have to learn advanced tools like Python and all, in case you actually want to do this for the industry. Right. So I think we will have to close the session, or like 2 minutes more. Can we have, Rupal?
Yes.
All right. So Raj has asked the same question, probably, which we have taken up. Okay, a little deviation. So in fact, actually has asked, why always drift take positive or negative slope gradient? Volatility can move share in both direction, right?
Yes. So volatility can move in any direction. Drift is a long-term variable. Drift is a long-term variable, and as drift is a long-term variable, it will be a fixed number. In fact, volatility also can be. I mean, see, volatility can always be positive. It can't be exactly. I'm not sure what you are talking about volatility. I think you are talking about the overall drift part. Well, not drift part, the shock part that we are taking. So shock can be negative because your normal distribution that epsilon value can be a negative number. If that can be a negative number, that can also be a negative number. Okay? That is the reason that shock can be either positive or negative, because of that epsilon term, which is a variable term, not a fixed term.
All right. Another very quick important question to me, probably. Sankaram has asked, Vedant has asked, R or Python, which is more preferable? At any day, Python, but Rupal, just like couple of pointers, your thoughts.
Yes. So why Python? Because now first of all, it is extensively being used in the financial industry. That is the first reason. Second reason is, what is the benefit that we are getting out of it? That as it is being extensively used, we can very a lot of libraries of Python. I think even for Black-Scholes implementation, you can have a quick library for Black-Scholes implementation. So basically, libraries are being prepared worldwide. Researchers and people like you and me, they prepare libraries for Python. And we can download those libraries and packages and directly use them. If we get a package or a library, it's lesser amount of code that you have to put, which is very easy for us. Why do we want to put lot of effort if already someone has done the work? See, no one needs to just keep on replicating the same thing. That is the beauty of Python. There are a lot of libraries which can be used. Apart from that, we are going to have another webinar on machine learning. Probably machine learning is something that has got a lot of implementation in Python. And artificial intelligence and machine learning are the new buzzwords today. And I think all of you might have already knowing this. The usage of machine learning in financial industry is something that we need to see. But again, that implementation in Python is also really quick and a better way. That is the reason that Python is used a lot. It's preferred a lot.
All right. So 2 more last questions, which I will be taking, and then we'll conclude the session. Right. So I'll take the questions of Sankar Ram as well as Masood together. These are related questions. So Sankar Ram has asked, can layman learn Python, or does it require IT skills? Rupal, let me answer this question. Right. And Masood has asked, in the courses that we do, do they get an introduction to Python, or is it expected that the individual need to have some basic coding experience in advance? Okay, so I'll answer both these questions together. First of all, Sankaram, I mean, if you already have some IT skills, that's an advantage. There is no doubt about it, right? Because at the end of the day, the Python that we'll be using this course is quite involved. It is not like something which is only academic. As I said, whatever we do in the course are industry grade. People coming out of our courses, they are ready for joining the desks. So that means whatever we do is industry grade. So it is not like just academic. So Python what is used in the course is quite involved. But said that, yes, Python. Okay, if you have good knowledge of Excel and if you already, then again, I would assume that you are also building good logical formulas, and that in that case, I would say that the logical structure is in place. That's an advantage. But what I was saying is, yes, if you have prior IT skills, that's an advantage, but it's not compulsory, because I mean, if you don't know it, what we do is we provide you access to a free module on the basics of Python whenever you join our course. It's a very well-designed module, a step-by-step guidance on things in basic Python that you need to know to do this kind of modeling. Of course, it will take a little bit of effort, but if you spend enough time with that module, you can learn the basics, and the more you practice, the better you get. And as I said, in the course, we teach you the actual modeling and implementation and all the advanced areas, right? But yes, if you don't know Python, then some effort is needed from your side. You have to use the free resource that we provide, the free modules on basic Python, and you can do it. A lot of people who join our courses are from pure finance background without having any programming knowledge. I mean, as it can be expected, right? As it can be expected, because finance people are not introduced to programming in any of their courses. But that is fine. That is fine. As I said, we provide you the resource, and you will have to learn the basics of Python using that. And after that, of course, we take up all the advanced stuff in the course. So I guess that answers both of your questions, Sankaram and Masood. Sankaram, for the basics, no, you'll not get a coach for the basics. That's it. The modules are quite well designed, and like again, if you really want to learn and make a little bit of effort seriously going through the module, I mean, it is more than good enough for you to learn the basics. But as I said, again, since a lot of people are from the non-programming background, in the initial sessions when the faculties are using Python, they are considerate to you. Maybe in the first couple of sessions, they would handhold you a little bit, they will be a little slow. But then post that, they would expect you to be quite well versed, and they'll pick up speed. So we try to do our best as far as helping is concerned. But I mean, during the actual course, the expectation is, I mean, you should be well versed with the basics of Python. Either you know it already, or you should be using our module to learn it properly. That's how it is. I think with that, that answers all the questions that we had for the day. And anyway, like we are half an hour past our session. So it was, the Q&A was intended only for 15 minutes, but again, we always love to interact. So that's fine. And I hope we have answered all the questions. So with that, actually, I will like to thank you, Rupal, for the session today. And thank you everyone for attending the session. And with that, we'll conclude the session for today. We'll meet at same time, 12 o'clock tomorrow, and we'll continue with the session and more importantly, the implementations in Python. Thank you.
Thank you.